Hey everyone, welcome to this week's stock and macro update. So this week I want to start off with a performance update for the 21 Disruptors Index. Then I want to get into three earnings reports from our disruptors that we got last week, and then I want to finish off by going over the employment report, which continues to be one of the big mysteries of 2022, and I'll explain why. So real quick, a performance update. So the Disruptors Index over the past week is up or down 7.6%. Versus the S&P 500 down 2.33%, Nasdaq's down 4.85%, Russell 2000 is down 2%, and ARKK, which is our growth proxy, is down 10.03%. So the Russell is actually the top performer of the group, and that is because a lot of the stocks in the Russell index are small cap, like oil, natural gas, some miners are in there, and those have been kind of hot. Some smaller banks, and yeah, those have been leading the market, especially the commodity stocks. So interesting to see that. Even though it's a small cap index, you can see the distinction. If you look through the components of it, it's a lot of small cap like oil and natural gas stocks. But yeah, growth has taken a beating, as you can see by our Disruptors Index, by ARKK, and by the Nasdaq, which obviously is tech heavy. The top three performers in the 21 Disruptors Index were PTC, which was up 7.07%. Ethereum was number two, and yes, this has not counted the onslaught that crypto has taken over the past 48 hours. This is as of the Monday close of the stock market. Ethereum was up 2.78%, and MP Materials Corp was up 2.45%. The bottom three performers, Proto Labs, got hammered after earnings. I'll go over their earnings next week. They were down 37.1%. The Trade Desk down 18.6%, and Lemonade down 17.52%. So some of the growth names that didn't even report got hit very, very hard towards the end of last week and on Monday. So first earnings report I want to go over this week is Guardant Health, and this is one of our healthcare stocks. Guardant's one of my favorite overall, like, life sciences, biotech type companies. They specialize in precision medicine, specifically cancer diagnostics using blood samples. And from what I've seen, they're really the farthest along in actually creating successful products that can actually successfully test for cancer using blood samples. And year over year, their cancer test revenue was up 28.7%. Their overall revenue was up 23.8%. Their clinical volumes were up 42% year over year and 11% quarter over quarter. And just after 5 months on the market, one of their newer products called Shield LDT has seen 8,000 orders so far. And that's with very, very little marketing. I believe that one's not even FDA approved yet. So they are, seeing early demand for that. And I think there's all sorts of demand out there for these newer and overall better and more healthy cancer diagnostic tools. And again, Guardant Health is one of my favorite companies because they're one of the farthest along, and I think they have one of the most interesting ways in detecting cancer. So another thing that they brought up in the earnings report was their operating costs. Because they are an early stage precision medicine company, the R&D costs are crazy, and it's going to be like that for years. So this is one of the few companies that is not cash flow positive yet that I would consider adding to the 21 Disruptors Index. Obviously, it is one of the 21, but usually I wouldn't add a company that was cash flow negative unless I was had very, very strong conviction that they were going to be successful. So the operating costs year over year were up 29.7%. They're nowhere near being profitable yet. They're not cash flow positive, but they do have almost $1 billion in cash, which is enough to fund their business a couple more years. And management did say, actually, in last quarter's report, that they expect within 2 years to be cash flow positive. So they do still have cash to fund their business for at least a couple of years, which means they won't have to take on much debt. They won't have to dilute the shares by offering more onto the market. Just wanted to differentiate why I believe that this stock is going to still be a winner despite being cash flow negative. And I haven't gotten to them in the weekly overviews that I do because of earnings season and everything with macro. It's been kind of crazy. but I will get back to highlighting one or two companies per week from our 21 Disruptors Index in future Substacks. Moving on to Livent Corp. So the ticker is LTHM. This is our lithium play. Some highlights from their earnings report: 126% sales growth year over year. Earnings per share growth of 1,267%. Operating margin grew from 6.37% to 45.47% year over year. And they made $199.3 million in free cash flow. And that's almost as much as they have in cash. But instead of blowing their money on dividends and share buybacks, Livent is being very smart with how they use that money. They are putting it all into expansion, and they're finishing up two big projects that's going to double their production by, I believe, the end of Q1 next year. So they have a facility in North Carolina that they are, I believe, wrapping up the final touches on the upgrade that's going to add 5,000 metric tons of capacity. And then they have another project in Argentina that is going to be done by the end of the year, and that's going to add another 10,000 metric tons of capacity. So they're going to be producing a lot more lithium products, and that is obviously good because the demand for lithium is through the roof, and as much supply as they can make, they know that they're going to be able to sell it like right away. So it is money well spent, in my opinion, and they actually have overall between 2022 and 2024, so that those 3 years, they plan on spending $1 billion to expand their production lines. So they're going to have a real great supply chain system going on within their own company that's going to make for very, very sturdy business going forward. Moving on to MP Materials. The ticker is MP. Some highlights: their revenue was up 24.7% year over year. Operating margin up from 59.14% to 63.62% year over year. A 51% increase in the realized price of the rare earth minerals that they sell, and record $1.26 billion in cash with just $685 million in debt. So financially, they're very stable. They have one of the best balance sheets I've ever seen for a commodities company. So they're extremely healthy. They are also going to see a very huge transition next year, going from what they call stage 1 to stage 2 in their business. And I go into a little bit more detail in the Substack, and I also did back when I wrote about MP a few weeks ago. But really, stage 2 moves them from being just a miner of rare earth metals to also a refiner. Right now, all of their all the metals that they mine, they send to a single producer or a single refiner in China. So on top of being centralized, it's also in China, which is obviously unpredictable with COVID lockdowns. You never really know when they're going to be able to get the work done and are available even to sell to. So it's going to be good for them to have their own refining business, and that's going to be a huge upgrade for MP in 2023, and I think the future looks very bright for them. Rare earth metals mining is finally branching out, and the U.S. is now the number 2 player, and MP basically has the entire rare earth business in the U.S. So I believe they mine like 15-16% of the total production of rare earth metals on the planet, and it's really their market to lose from here on out. So I think this is a great play on commodities in general, because rare earth metals are in demand for all kinds of new energy things, from electric cars to solar panels to wind turbines. So it really checks a lot of boxes when it comes to new energy. Okay, so moving on to the employment report. So if you look at the surface level information here, this is a great example of why the headline data doesn't tell the whole story, because the data came in and said 261,000 payrolls were added to the economy versus estimates of 200,000. So it looked good on the surface. But if you look deeper into these unemployment reports, there are actually 2 different surveys that it covers. One of them is the establishment survey, one of them is the household survey. And again, I go into this in more detail in the Substack, but I'm going to go pretty light on it for the video. Just want to point out some key differences here and kind of reconcile where we are in the overall jobs market from a strength basis. So the establishment survey is the payrolls number. The household survey measures the number of employed people. So it's kind of like the number of jobs in the economy right now versus the amount of people who are employed. So if someone takes a second job, for example, it'll show up as an increase in the establishment survey, but not the household survey. It's another job added to the economy, but it's not another employed person. Household data also counts jobs in the agriculture industry, which is not included in establishment, which is why you see it called non-farm payrolls. And third, the household data also includes people that are self-employed, but the establishment data does not. So because when you're self-employed, it's not usually like you're not usually on a payroll. Essentially, you just pay yourself. It's not as formal. So according to the household survey, October actually saw a decrease of 328,000 employees versus the 261,000 added payrolls in the establishment report. So that's almost a 600,000 job difference, which is crazy in the same employment report. That marks the third time since March where the payrolls were up, but the number of people with jobs was actually down. And since March, there's been a 2.3 million job difference between the two. So huge discrepancies. That's very unusual. Usually these are kind of in line with each other. There's not usually a huge difference, but again, 2.3 million job difference is definitely something to note, and would definitely make any rational person question which one was right and is the job market actually healthy. So I want to try and reconcile the differences. It doesn't add up to me, but the number of multiple job holders actually went down 250,000 in October and is only up 126,000 since March. So it's not that people are getting more jobs, because like I said, if someone takes a second job, it's increase in the establishment, so it can bloat the establishment numbers, but a difference of 126,000 versus 203 million just doesn't do it for me. Another reason is either the difference in self-employed or working in agricultural jobs. And again, if either one of these loses workers, it would make the payrolls number exceed employment. So that would be another reason that the establishment survey could be inflated. But these two areas are only down a total of 150,000 jobs since March. So that would not be, again, 150,000 versus 2.3 million. Even if you add in the multiple job holders, that's 276,000. That's like, 13% of 2.3 million. Does not account for the difference. Another difference that I've seen people bring up is the amount of people that have either lost a full-time job or gained a part-time job or both. There's been, I think, 490,000 people that have lost a full-time job, and 492,000 people have gained a full-time or part-time job. But still, that's not enough to reconcile the 2.3 million difference. So again, this is one of the big mysteries of 2022. Really creates some uncertainty around the strength of the jobs market. Personally, I think the jobs market is still very strong, if not because of the employment rate being 3.7%, which is still very low. I would say that the fact that there's still like 1.8 job listings for every employed person suggests that there's really no danger of an employment spike or unemployment spike, I would say, within the next 1 to 2 quarters. So I'm not looking for mass layoffs anytime soon. We are seeing a lot of weakness in tech, in that job industry, but as far as overall job strength or job market strength, I think it's still very strong. This is not something that's going to change overnight. So I'm not really worried about the 2.3 million job difference. I wanted to bring it up because I think it's something we should be aware of. And I would love to know what the reason is for this, but I just haven't been able to find it yet. Haven't seen anyone else be able to find it yet either. So it remains a mystery, but hopefully we can get some good insight into that soon. But again, for now, I think the jobs market is still very healthy, and it is the reason that we have not seen really any damage done to the economy in a meaningful way yet, outside of the housing market and maybe the auto market. So that is it for this week. If you have any questions, definitely leave them below or comments, And thank you so much for watching. I will see you again on Friday.